Hi there, welcome to ProTax Accountant. If your April 2026 payslip looked lighter than expected, stay with me now. I'll walk you through why. Hi there, welcome back to PTA. In this video, I'll walk you through the April 2026 income tax changes every UK taxpayer should understand.
You might have noticed a frustrating disconnect recently. Your business revenue is up, or your employer finally gave you that cost of living raise. But when you check your bank deposits at the end of the month, the actual net pay hitting your account has barely moved. Or worse, it's gone down. This chart shows exactly why that is happening. The UK tax burden has now reached 38% of GDP. That is the highest level in modern history, and it means the state is actively capturing a larger share of every penny generated in the economy. Navigating an environment where the rules are designed to squeeze margins means your financial strategy needs to evolve. ProTax Accountant acts as the partner you need to help you retain the wealth you are actually generating. The political messaging leading up to the 2026 tax year was highly specific. The government kept its manifesto pledge to avoid raising the headline rates of income tax. On paper, the base rates remain untouched. This split-screen comparison of a 2024 payslip versus an inflation-adjusted 2026 payslip reveals a coordinated stealth tax strategy. Even though the gross salary on the right increases to match inflation, the net pay remains totally flat. Back-end adjustments absorbed the entire raise. We are going to break down the mechanics behind these current rules. We will look at exactly how they target standard employees, high earners, and business owners, the strict new compliance steps you have to take, and the costly mistakes you need to avoid. Figuring out why your paycheck shrank means ignoring the headline rates entirely. You have to look at the specific stealth traps actively draining your exact income bracket. The first major trap hits standard PAY employees through a hidden mechanic called fiscal drag. The personal allowance is frozen at £12,570, and the higher rate is locked at £50,270 until 2031, while inflation rises. Therefore, 100% of any cost of living pay bump is pushed directly into fully taxable brackets. You cannot shelter it. Employees are also taking a secondary hit. The government has completely abolished the standard £6 per week home working tax relief that became normalized over the last few years. Remote workers who previously claimed this allowance without needing to provide receipts will see an annual loss of between £62 and £124 in tax savings. For the average employee, nominal wage increases are currently yielding diminishing returns. The state is capturing your purchasing power simply by keeping thresholds frozen and stripping away normalized reliefs. The math gets significantly more hostile for professionals earning over £100,000. They face a severe mathematical anomaly built directly into the tax code. This chart shows the personal allowance taper. For every £2 earned above £100,000, you lose £1 of tax-free allowance. Losing this allowance while paying the 40% higher rate creates a hidden 60% tax. With national insurance, total deductions reach 62%. The real-world trade-off is brutal for high earners. If you receive a £5,000 pay rise, that raise will yield a mere £1,900 in actual take-home pay. Professionals navigate this by aggressively using salary sacrifice. Instead of taking the cash, they divert the excess income directly into their pensions. By sacrificing that portion of your salary, you keep your adjusted net income below £100,000. This legally rescues your tax-free allowance while actively building long-term wealth. High earners face an additional squeeze if they utilize company car schemes. The benefit-in-kind rate for zero-emission electric vehicles has now increased to 4%. This rate increase bumps up the cash equivalent value added to your taxable income. You end up with a higher tax deduction on your PAYE code, reducing your monthly net pay for driving the exact same vehicle. Earning over £100,000 triggers a penalty phase. Accepting traditional salary bumps in this bracket destroys value, unless you actively divert those funds into tax-sheltered vehicles. Business owners and directors face the most complex scenario of all. They are dealing with a simultaneous assault on payroll costs, profit extraction, and compliance. Employer national insurance has seen a drastic adjustment. The employer rate climbed to 15%, and the secondary threshold, the point where you start paying NI on a worker's salary, dropped significantly from £9,100 down to £5,000. Employers now pay an extra £615 per year for every single employee earning over the threshold, strictly because of that drop. This creates a heavy macroeconomic ripple effect. The sudden spike in payroll costs forces business owners to suppress gross wage increases for their staff, acting as an invisible drag on national wages. We are now looking at a massive divergence in the labor market. Because of these structures, a typical PAYE employee currently pays roughly 55% more direct tax than an equivalent self-employed worker. Profit extraction is also heavily targeted. Dividend tax rates have increased by 2%, bringing the basic rate to 10.75% and the higher rate to 35.75%, while the tax-free dividend allowance remains frozen at a mere £500. The traditional small business strategy of taking a low salary and paying out high dividends is heavily taxed under these rules. It requires a complete restructuring of how directors compensate themselves. Finally, sole traders and landlords are now dealing with a massive operational burden, making tax digital for income tax. If your gross income is over 50,000 COMs, you are legally mandated to purchase HMRC-compatible software and submit quarterly financial updates. The days of submitting a single annual return are over. For business owners, relying on last year's operational playbook now guarantees thousands of pounds in unnecessary tax leakage and severe compliance friction. The period of affording a passive approach to tax compliance has passed. To maintain your standard of living, you must transition to active wealth management. To protect your wealth in 2026, there are 3 critical compliance mistakes you must actively avoid. Mistake 1 is ignoring MTD deadlines. Failing to digitize your financial records immediately will trigger severe, compounding new late filing penalties. Mistake 2 is taking a straight salary over £100,000. Accepting a bonus that tips you over the 6-figure mark without immediately utilizing pension salary sacrifice will expose you to the 60% trap. Mistake 3 is failing to claim the employment allowance. Business owners must actively apply for the £10,500 allowance to offset the employer NI hikes. It does not roll over automatically. Keep in mind, this video is for educational purposes only. Tax law is highly complex and individualized, and this does not constitute formal financial advice. To optimize your remuneration, ensure flawless MTD compliance, and legally protect your hard-earned wealth, contact Pro Tax Accountant today. If you found this breakdown helpful, please like the video and subscribe to the Pro Tax Accountant channel for more definitive guides on navigating the UK's shifting financial landscape.